Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for the segment, we have James Ragan, Director of Wealth Management Research at DA Davidson, to discuss the investment impact of rising inflation and the war in Ukraine. James, it's great to have you with us. Welcome to Trade Talks.
Yeah, thank you so much. Glad to be here, Jill.
You got it. And let's get a recap of the U.S. stock market performance since the war in Ukraine escalated. It certainly has been a lot of velocity in these moves.
Yeah, just looking back now, after an initial decline post-invasion, U.S. equities have recovered all of those losses, indicating, at least for now, that investors are looking past the conflict. We saw about a 7% decline in the S&P 500 from February 16th, which was kind of the beginning of the invasion. And really the decline was led by a lot of the growth sectors: consumer discretionary, technology, communication services. But through that period, not all the sectors were down. We saw, of course, energy has risen, but we saw investors become a little more defensive. Utilities were up over that period, and the REITs were up over that period too. But since March 14th, we've seen the market recover all of those losses, go to above levels pre-invasion, and it's really been risk on. All 11 sectors are higher, but it's been led by those same growth sectors that were leading on the way down: consumer, technology, and communication services.
How much of global GDP does the Russian economy contribute? And what about Russia's role as a U.S. trade partner?
Yeah, we estimate that Russia is a relatively small contributor to global GDP. We estimate about 2%. Also, pretty small U.S. trade partner. I think the U.S. 2021 only exported about $6.5 billion to Russia in goods, imported 30 billion or so. But beyond that, Russia is a fairly significant supplier of global oil and gas, grains, metals. So there is a larger impact than their GDP contribution across those areas.
In your opinion, are the sanctions having any impact, and will this continue to put upward pressure on inflation?
Yeah, I think that has been the impact we see is on inflation. Obviously, oil prices rose significantly. I think Brent crude oil was at one point 46% higher post-invasion. It's continuing to be pretty volatile. I think even this morning, after a pullback, it's still 12% or so higher. We've seen higher prices for grains and different metals have been higher as well. So I think the impact on U.S. inflation is where we'll see it. According to the CPI, which comes from the BLS, energy is about 8% of CPI, the Consumer Price Index. Food is about 13%. So we're going to see pressure on both of those areas for the next few or even several months, where we previously had thought that we'd see some relief in inflation as some of the services took the place of goods again. We're going to see that that's going to be offset by the oil and food prices. So we should see elevated inflation for longer than we previously thought.
And James, you pointed out that interest rates are moving higher, but real rates are still negative. Explain to us what that means.
Yeah, so if you look at, just on interest rates moving higher, we're seeing the 2-year Treasury since the invasion has moved to about 2.4%. I think it was 151 to start. The 10-year Treasury is about that same level, 240, 245. It was 205 on February 16th. But if you add in, say just a core inflation rate of 6 or 7%, real rates are negative 4% or so. That's just subtracting the inflation rate from the nominal rate. So I think there's a few potential reasons for this. What's keeping those real rates low? I think first and foremost is inflation expectations in the future are much lower than today. So if you look at some of the forward contracts, investors are still looking for inflation to level out in the years ahead. And then also I think there's a lingering concern perhaps that slowing GDP growth in the U.S. could be keeping those longer term rates low.
And finally, James, what's your outlook for the balance of the year? And what sectors do you think are poised to outperform?
Yeah, so I think we're still relatively positive on the markets for the year. We would have been much more positive a few weeks ago. I think we've made back a lot of the gains that we expected. We do think we'll be at a little bit higher than we are today by the end of the year with some volatility along the way. We continue to favor large cap companies that have pricing power and can successfully navigate through the inflation pressures that we're seeing. Looking at the war impact and some of the longer term sectors that maybe have done well in the short term, which we think will continue to do well, would be energy, defense stocks, software, especially in the cybersecurity, and some stocks that have some agricultural exposure. We do see the potential for the higher interest rates to negatively impact housing. So we're going to keep an eye on that. We think that if the market pulls back again, which we could see, that defensive sectors would hold up relatively well. So we like some defensive exposure, but we don't want to be overly defensive in here. We still think that, we're going to have earnings growth and GDP growth, and the cyclical sectors, should outperform for the full year.
All right, James, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.